In this video, I'm going to tell you about the best, safest, and easiest long-term investment strategy. This investment strategy requires very little work or skill. It's actually meant for people who are risk averse. It's for people who would much rather not lose any of the money that they have worked hard to earn and save than make risky investments that could generate huge returns but could also result in huge losses. I'm very risk averse because I've already had my share of making stupid investment choices in my younger days, which resulted in my losing about $120,000 of hard-earned money. And I'm not talking about money in gains that were not realized. In other words, I'm not talking about money that I could have potentially made but didn't because I sold my stocks too soon or waited too long to sell my stocks. No, I'm talking about $120,000 that I had saved up for years that got transferred from my bank account to my brokerage account that I bought stocks with, and the stocks lost all of their value because the companies declared bankruptcy or plummeted in worth to the point that they would never be able to recover in 100 years, even if they were to remain in business that long. And I bought these stocks based on the recommendations of my coworkers, which is why the one thing that I would never do is to recommend specific stocks to anyone for them to buy or to stay away from. I don't invest in specific company stocks anymore. What I'm going to teach you today is a well-known investment strategy that truly minimizes your risk while giving you returns in the long run that are much better than just keeping your money in the bank in a savings account or a certificate of deposit account. Those will keep your money very safe, but the growth will be minimal. The paradox of this investment strategy is that it's ideally suited for long-term investing and investing for retirement and should be started when you're very young. But when folks are young, letting your money grow long-term is not as appealing as taking greater risks in the hopes of seeing your money grow quickly. And the older folks who have been there and done that and are able to recognize and appreciate the merits of this investment strategy are most likely not going to be in the best position to really take advantage of it if they're just starting out now. The reason is that this investment strategy, which involves investing in index funds and dollar cost averaging, requires you to be in it for the long run to be able to ride out the highs and the lows of the market. It's so important for people to practice investment strategy as early as possible when you are young, but young people have way too much energy to just let money sit passively. For most young people, it's so much more exciting to be actively trading stocks in hot companies that everyone else is talking about, and they get swept in this fear of missing out. The most in-your-face investment opportunities right now being in cryptocurrency, and there are a lot of different cryptocurrencies to buy out there, none of which I'm going to mention in this video. Also, young people tend to be much less risk-averse because they have youth and time on their side to recover from losses. So this type of boring investment strategy is not likely to appeal to them. Most older people would recognize the wisdom in this strategy, but by the time they've tried this and tried that and have learned their lessons along the way to come around, it might be a bit too late for them to take full advantage of this investment strategy because they might not have time on their side to stay in the market long enough to ride out the highs and the lows. In other words, when you need to draw down on your investments for living expenses during retirement, the timing could coincide with a downturn in the market and you might not have reaped the growth in the market. Anyway, the best strategy for investing your money so that it increases in value while still minimizing the risk is very simple and requires you to do 4 things in order to be successful. 1, invest in index funds. 2, dollar cost average. 3, start as young as possible. And 4, stay in it for as long as possible. So what's an index fund? An index fund is a mutual fund or an exchange-traded fund, an ETF, whose portfolio of holdings, meaning the stocks or bonds that make up that fund, mimics or tracks the components of a financial market index, such as the Standard & Poor's 500 index, called the S&P 500. So by purchasing shares in an index fund, you're purchasing a little bit of whatever that fund owns. And for an index fund that tracks S&P 500, for example, you would be buying and owning a little bit of all the companies that make up the S&P 500. So you minimize the risk of an individual company doing poorly, because in the mix of S&P 500 companies, you will have other companies that will do well. So what are the most popular indices? There is the S&P 500, which is an index of the 500 largest U.S. publicly traded companies. There's Russell 2000, which was started by the Frank Russell Company in 1984, and it's an index made up of 2,000 small cap companies. And then there's Wilshire 5000 Total Market Index, which is the largest U.S. equities index. This is a broad-based stock market index of publicly traded American corporations. It reflects the entire U.S. stock market. The Wilshire 5000 includes about 3,500 companies now, although it held 5,000 companies when it was first introduced in 1974. So what are some of the advantages of index funds? Diversification and low fees. Index funds help minimize risks by providing diversification. So instead of having all of your eggs in one basket, if you were to invest in one company or just a few companies, through index funds, you can be invested in several hundred or several thousand companies, such that the performance of some of those companies that don't do well will be balanced out by the performance of others that do well. Also, index funds have very low fees. And that's because there's no cost associated with paying a fund manager to actively manage the fund, which would involve spending time to research and identify great performing stocks and then buying and selling them at appropriate times, with the goal of seeing to it that the fund that they are managing performs better than the market. Index funds are passively managed and adjusted to reflect the market index. The bottom line is that you don't need to worry about how your particular stock is performing or how your particular sector is performing if you buy shares in these index funds. You can just sit back and let your investment grow over time, because in the long run, the market will be trending up. I'm not going to mention any specific index fund by name because, as I've told you before, I've made it my policy not to talk about any specific investment vehicle by name, because I don't want to be responsible for anyone losing money from buying shares in a specific company or a specific fund or a specific investment product that I recommended. There are many index funds out there that are rated very highly, and if you Google best index funds, you can easily find some great ones. Now, you can purchase index funds that are mutual funds or ETFs. Many folks will tell you that mutual funds have higher expense ratios or fees than ETFs because there's still a fund manager associated with mutual funds, while ETFs do not. That is simply not true. There are mutual funds whose expense ratios are lower than those of ETFs. Since these fees affect your total return, you need to look up and compare the expense ratios for the mutual funds or ETFs that you're interested in. Here are the simple steps. First, choose the index. I've already named 3 stock market indices earlier in this video. There are a lot more. By the way, there are also international stock indices and bond indices. Second, pick the specific index funds you are interested in for that index. For every index, you are going to find lots of different funds that mirror that particular index. Third, do some research and compare the expense ratios for different index funds. Most brokerage accounts have this research function. There are many great index funds with expense ratios of 0.03% or less. If the expense ratio is higher than that, you might want to consider a different fund to buy, and that would be a personal tip of mine. Fourth and last step is to make your pick and start investing. Now I'm going to talk about dollar cost averaging, which is the best investment strategy to manage market volatility. You can't time the market, meaning you can't predict when stock prices will go up and when they will fall. It's tricky to try to wait for the stock prices to fall to get in at a good price because it's really hard to predict when the downturn or the upturn in the market will reverse course. And that's why there's the saying that time in the market beats timing the market. So just get in the market as soon as you can and hold for longer. So what exactly is dollar cost averaging? Dollar cost averaging is the practice of buying into the market in smaller trades that are consistently made at regular intervals over a long period of time instead of buying your position in a large amount at once. So dollar cost averaging minimizes the risk of buying at the top of the market. A lot of people who dollar cost average invest a set amount once every couple of weeks, and brokerage companies like TD Ameritrade have an automatic purchase program that facilitates this. If you have a certain percentage of your paycheck going towards your 401k every week or every couple of weeks, then that is fantastic. You are already practicing dollar cost averaging. For those of you who might be new to investing, I think I'll make a video later on different brokerage firms such as Vanguard or Fidelity that you can open an account with to buy funds. Anyway, we've come to the end of my video on investing, and I really hope that this information will be helpful and useful to some of you.